Maura.
How are we doing, Deb?
Good.
Good. Okay, great.
We'll give it a couple more minutes.
Okay, sounds good.
Hello, Deb. Can you hear me?
Yes, I can, Jim. Hi, how are you?
Oh, good, good. Hi, Maura. How are you?
Hi, Jim. How are you? Thank you for doing this.
Oh, my pleasure.
We
Thanks
really
for having me.
appreciate it.
Yeah, my pleasure. I'm really flattered.
That's really quite the background that you have there. Is that
Yeah, you know, I was trying to find one, and I had my standard analyst solutions one, but I also do have a Chicago background. So I thought, you know what, given that we're here in Chicago, we're going to use that today. So
very
Nice.
good? Very good.
Jim, we're just going to give it a couple more minutes before we start.
yeah, sounds good.
Okay.
So, Jim, just so you know, this is being saved for prosperity.
Oh, awesome.
This might have a shelf life of many, many years.
Well, that's awesome. There are still sometimes people will email me and refer to presentations I did, 5, 6, 7 years ago, and I'm like, oh, okay, I guess it's still out there. Candidly, not much changes, and I initially at one point thought in my career that there should be a lot changing, and there are some parts that do. But when I was on a panel with Oswald the Motorin from NYU, and he's from my perspective the expert on valuation, and he said, I get invited to these CFA events every year. He says, all I do is I just keep repurposing my prior work. He said, I even tell them that now, and they still invite me back. He said, not much really changes from one year to the next.
The fortunate thing is that all of our research challenge participants are new every year.
Yeah.
So they
It's all new to them.
So you have a new audience all the time.
Exactly. It's new to them, right?
Yeah,
That's right.
Yeah, it's all good.
Yeah, good.
We really appreciate it. So just be
my
aware
pleasure.
that what we will do today will live on for eternity.
Wow, that's pretty amazing.
Wow, is right.
Right.
Well, why don't we go ahead and get started? We might have some stragglers that call in, but that's okay. We'll have this recorded. Everyone, I would like to welcome Dr. Jim Valentine. He is a managing partner and founder of Analyst Solutions. He's also the director of the AIM program at Marquette University. He wrote the best-selling book called Best Practices for Equity Research Analysts. I have that book myself. It's fantastic if you like that kind of thing.
Thank you.
He was also a professor at DePaul and went through a couple of seasons with us here in the competition. And finally, a long time ago, he was a managing director at Morgan Stanley as director of research there. So we've got somebody here that has a ton of experience in equity valuation. We're going to be able to learn a lot from him. So Jim, go ahead and take it away.
Oh, fantastic. Thank you so much, Deb and Maura. Can you see a slide that shows equity research?
Yes.
Yes.
Okay, awesome.
It looks like a crash test dummy there in front of the
well,
chart.
and for
Very appropriate.
For the students, they'll probably know what this is. This is this was one of the first memes for Wall Street, and it personifies the stupidity that was out there with a lot of these meme stocks back in the the COVID era, and so we're going to try to avoid doing that, and instead we're going to try to do some research here. So I've got a lot of slides. This is just kind of classic way I go, and I'm going to go really fast. If at any point you have a question, you can just jump in or follow up with an email. But here we go. Just a little bit of background here. So when I was in charge of analysts at Morgan Stanley, I was in charge of training and development on a global basis. So what I did is I ultimately tried to figure out, what do they do? Now, I had already been an analyst for 14 years, so I had a pretty good idea. But I went around the world and I created a committee of about 10 analysts, and we cataloged over 100 things that analysts do. And I started putting it together. And then when I started my own company, I kind of just pulled it together in this format here. And that the gamma pi, the first letter of each of these of gamma pi, each of these letters represents a different stage of what analysts do. And so this idea that we start here and we generate informed insights, we move our way around. If we had good insights, we go and try to create good forecast. If we've got an accurate forecast and it's out of consensus, we probably have a stock recommendation, which brings us over here. And then we want to take that idea and not just communicate it, but want to make sure we motivate others to act. And then if you're on the sell side, you've also got to get buy-side votes. And then all the while down here in the lower right, you're going to be thinking about being productive with your time and information flow. And you got to think about how your own individual characteristics can play a role in how you ultimately do your job. Because in the whole world of behavioral finance, we know that can be play quite a role. So what I thought I'd do today is go through some steps that I've modified this a little bit. So we're only going to focus on the things that you would typically see in the CFA challenge, but CFA research challenge, but meaning that I showed you that prior slide, some of those things you're not going to be doing in a college setting. So I'm going to walk through the key things, and then I'll hopefully be able to give you some frameworks and ways to think about these things. So the first step to identify what I call the critical factors for your stocks. And I'm going to talk about what those are in a second. And there are two frameworks we'll be using. The first one is, but before I jump into what is a critical factor? Well, if you think about a typical day, especially if you're an equity research analyst or a portfolio manager, you're getting bombarded by noise. And you might be getting, I know some portfolio managers say they get over 500 emails a day, and a lot of these are trying to communicate stock ideas. And you can get easily 500 news stories of all the stocks in our portfolio in a day. Portfolio managers that I've worked with tell me, they could have 40-hour days and still not go to all the meetings and conference calls that they ultimately get invited to. So there's a lot of noise out there. And so what you ultimately have to do in this job to be successful is you got to narrow it down to just what I call factors. What are let's say the 5 to 20 factors that you really need to be thinking about? So when you're thinking about your CFA research challenge, think about that stock that you're looking at and all the noise out there, and try to distill it down to just some of the most important factors. But then what I really want you to do, and this is what successful analysts do, is they narrow it down to this kind of 1 to 4 critical factors. The best example I think that we can all probably relate to that I can think of is for Apple. You may have somebody say, I'm going to go off to a developers conference where they're talking about the new wearables. Okay, great. You can go do that, but it's probably not a critical factor. It might be a factor here, but my guess is it's more noise. And so why would you go waste time trying to figure out the new software that's going to be in the wearables 3 years from now when it's probably not going to be a big deal? Now you may go, well, Valentine, how do I figure out what's a big deal, what's not? Well, that's why I created this framework here called the EPIC framework. And then you think about something you might be spending time on, you might want to spend time on in the stock you're going to be looking at or starting to work on. And ask yourself these 4 questions. Is whatever I'm working on, is it likely to exceed my materiality threshold? And typically that means, will this thing that you're working on cause earnings to get revised up or down by at least 5%? If not, like wearable software, probably not going to impact Apple's earnings more than probably at all, but definitely not more than 5% in the next year or two. So it probably fails right there. And that's why it's the first part of the EPIC framework. The second question, is it probably going to occur during your investment time horizon, which for most institutional money managers is somewhere between 6 and 18 months. So if it's something that, look, this is the wearable software is not going to really change the wearable devices for 5 years, it's probably not a good use of your time. The third thing you have to say, am I good at forecasting it? Namely, if you can't forecast it, if you're completely guessing and saying, hey, let's go and buy this stock because we think the recession is going to hit in 6 months and then be over 6 months later, well, then you really don't have a call because anybody could do that, right? And you probably have no predictability on that. So ask yourself, when you're looking at the things you want to focus on for your stock pitch, can you forecast it? And then also kind of on the flip side of that, will consensus be poor at forecasting? Because if you're looking at a company that's really good at telegraphing the results all the time, and the analysts keep nailing it over and over and over again, your ability to come in and do proprietary research and come up with something unique is going to be much more difficult, right? So if you do all those things, if what you're looking at meets all 4 of those criteria, you probably have a critical factor. Now you might be going, well, how do I find these critical factors for my stock? And this is going to be a very busy chart that our table, these slides are available to you. So a lot of these slides, because like I said, I'm going to go through them pretty quick. They're more to give you a flavor for how these frameworks work. And if you want to use them, you can then delve into them more deeply. But the idea here is that it's called a help framework. And the idea is that if you're going to start to do research on a company that you don't know that well, over here, the H is historical. So first you go back and research historically, When is the stock out or underperformed substantially from its peers or the overall index? And can you find times when the company really missed numbers or there were big revisions up in the numbers? And looking at Refinitiv, I think you all have access to Refinitiv, you can see this. You can go and chart this and look at what's been going on with historically with the company's expected earnings power. Then you can overlay that where you see those unusual times and whether of outperformance and underperformance with things like macro data, or it could be company data, it could be simply just earnings, revenue, or industry data. And what you start to do, and you can do this pretty simple in Excel, you start to see other relationships. When the stock underperforms, something's going on at the industry or the company level, or it could be even at the macro level. And that starts to give you a feel for, am I looking at an economically sensitive stock? Am I looking at more a company that's really, a stock's really driven more by the revenue growth? And once you know that, then you can start to, and you've done the what I call overlays and underlays in Excel or in any other kind of quantitative app. Then you can go and start to delve into this by following and following up and reading and looking into some of these different documents. I call these kind of read-only documents, in that they're helpful. They'll get you up to speed, but they're not necessarily going to give you a unique insight that other people don't have. So that's the idea of looking at historically. The next part here is going and looking at the emerging factors. So you go down the same kind of path in terms of looking for anomalies, but you're looking for right now, is my stock priced substantially above or below valuation levels where it's been over the last 6 months, 12 months, even the last 2 or 3 years. If it's not, then there may not necessarily be something newly emerging, but if it is, very often that does tell you something. And you're going to do the same thing here that I just did over on the historical, but in terms of going back and looking at these various documents, but you're only going to look at the most recent. You're just going to say, I want to look at the most recent quarterly call transcript, go look at the Q&A section. That's usually the first thing I do. If someone says, here's a stock, real quick, tell me in 15 minutes, what are the controversies? I go grab the most recent quarterly call transcript, go to the Q&A, see what are the analysts asking the company about, what are the big investment debates. So that's the idea of the E and the help framework, is look for the emerging factors. Then you go on to the L here, and you want to reach out to live sources of information. And this is a big thing that the best analysts do. I find some student teams will do this because it's very hard to have a differentiated view by using these read-only sources that I have over here. So I start to go and I look at these. You don't have to go to all these different sources. You find 1 or 2 that are reliable, and they'll help you they'll either refute or confirm some of the things you did over here. And then once you're done, and you kind of pulling all this together, you go through that EPIC framework again. You say, well, all these things I'm working on, do they really fall through the EPIC framework? Are they a critical factor? And if so, you presumably will have a differentiated view at this point. These are some critical factors for some stocks that over the years, analysts that I've been coaching one-on-one have said, this is my critical factor. And so over time, I just throw them in here. I don't go back and ask them to revise them. So some of these may be a little bit dated, but they give you an idea of what a critical factor would be for a company. So that went through this idea of first, identify the critical factors for your stock. If you don't do that, you're likely to be spinning your wheels, spending time going off on tangents, off in the weeds on things that aren't really that important to your stock. Once you've done that, then you want to come up with proprietary insights. And I want to talk a little bit about the idea between insights and information. So you've got these examples here where the analyst or the student comes out and says, well, Apple just unveiled an iPhone Plus. This, back when they came up with the new big iPhone, it was kind of the last real big change here. And in terms of form factor, and you say, wow, they're coming out with a new phone. Okay, great, but that's not an insight, that's information. So what you want to try to do is say, no, but the new iPhone is likely to increase its market share by a certain amount because it's got a faster processor or people want a bigger phone. So think about doing more than just simply providing information and provide insights. Because if you think about it, if you look at what we do here as equity research analysts, these are all the things we can say that we do as equity research analysts, they don't differ from journalists. And I did a search here about 2 years ago, and the average journalist in America is paid $55,000 a year. And that's well below what an average equity research analyst hopes to make. And so the question is, what do we do different? And the big difference here is that we're supposed to be forecasting the future. Journalists generally don't try to forecast the future. And it's hard to do. It's really hard to do because you're putting yourself out and you might be wrong. But that's what we as equity research analysts, and that's what you as students doing this research challenge should really think about, is how do I try to forecast the future and really have a strong view about the future that's better than consensus. And so I'm going to move a little bit in this area where analysts that I find are really good at doing this proprietary research, they stay laser focused on these 2 questions. They're asking, what is the 1 or 2 factors going to move my stock? So if I'm looking at Apple, I'm just concerned about the iPhone 15 next year. What are the features going to be? What is it going to cost to produce? What's it going to be sold for? All those things, I really need to understand the success or failure of the iPhone 15. It could be right now, given the fact they just came out the 14 here, 2 months ago. Maybe it's how much of a an upgrade cycle we have here over the next 6 months, 9 months, but definitely next year's iPhone 15 will be an issue that, let's say 6, 12 months from now, that people are going to be focused on. So once you know that factor is where am I going to get those unique insights? And that's super important. So why does that matter? Well, let's just say that we were going to look at a stock that was trading right now about $90. And we went out and we asked let's say there's 30 analysts that cover the stock. So we'll use McDonald's. McDonald's is a good Chicago-based company, right? And so there's 30 analysts covering McDonald's. We go out to them, we say, what is your price target a year from now? But now don't give us just one price, give us 10 prices each and put a probability on where you think the stock will be. So there's let's say a 20% chance the stock's at 100, there's a 10% chance the stock's only at 90 and so forth. Well, if we had 30 analysts that cover the stock that publish estimates on it, they each give us their 10 estimates, we'd have 300 estimates, right? And if we charted those, they might look something like this. And that ultimately we'd say, well, the mean price target out there, the one number you'd see in Refinitiv or Bloomberg or FactSet would say $100. Well, if we then went out to, let's say, the 3 or 4 smartest analysts out there, we went and found like the 2 that get rated the highest on, I think it's Refinitiv does I think it's called Estimize or something. There's a term they use for the best analysts in terms of predictability. And we went and got those analysts. We took 2 of them, and let's say we went to the 2 biggest hedge funds out there and took their 2 restaurant analysts. And we said, what's your view on this? Give us your probability of price targets. And it would look like, I think it would look different. And I'm just going to illustrate the point by saying it might look something like this. What are the 2 things that hopefully are standing out here are, one, that there's a difference in the prices, right? That ultimately you're coming up with a different view on what the value is and where the stocks like to be in a year. But second is that you can see for the analysts, the 30 analysts there, that we have fatter tails here. There's less certainty, right? And you have more conviction here among these 4 analysts that really know the company well. And so if I just show you the difference here, I would chalk it up to what we call information asymmetry. If you think about symmetry is when everything's the same, right? And if everybody in the market has the same amount of information, which things like looking at company quarterly filings and listening to their conference calls, everyone has access to that. So to really have an outsized view, to really generate alpha, which is in effect an outsized return over the life of your performance, you have to have some kind of unique place to go, information asymmetry. This is where I'm a big advocate when I'm working with analysts one-on-one and doing my training, and also even with students. Go out and find something that's not understood by the marketplace here. And too often what analysts do is they go out and they just talk to company management. And these are all the problems why you can't rely purely on company management. Not only does everyone have access to them, and therefore you can't get information asymmetry, but then you've got these problems as well. So you may go, well, how do I think about this? I've got a whole framework, and I'm not trying to over promote the frameworks here, but I want you to know there is a process you can go through. Unfortunately, the scope of this call is not going to be able to go into a lot of depth here, but the process to really get some good, unique insights so you have information asymmetry is to start by saying, what is the critical factor, the 1 or 2 critical factors for my stock? Because once again, if you don't know what that is, you're going to spin your wheels and be spending time in the weeds. Once you know that the Apple success of, let's just say, we'll go back to the iPhone 14 that came out in September, it's how many people are going to buy this, meaning how many people really see the need to upgrade versus are going to wait till the 15 comes out or switch over to an Android. And so knowing that's a critical factor, that's where we're going to spend our time. Then you got to say to yourself, where am I going to get these unique insights? I can't give you the exact answer here. If I was a sell-side analyst here, I might do proprietary surveys, which back when I was at Morgan Stanley, Katie Huberty used to cover that stock, and she did that. She did all kinds of proprietary surveys. You might spend some time going over to Taiwan, where they produce a lot of the kind of inventive work on what's going to be in the next iPhone or any mobile phone is being done. This kind of thing that is not ready quite for prime time, but it will be potentially in a year. So doing these types of things, finding source of insight is really important. These next steps here, I'm not going to spend much time on because once again, a little bit beyond the scope of what we're talking about, but you do want to think about putting together a list of questions so that you're not wasting the person's time. You want to make sure you're introducing yourself, being polite about it, and then following up, thanking them, and then going back to them if you have more questions and they're relevant to your critical factor. So there is a framework and a way to kind of think about this idea of how do I go and approach individuals. Now we've got this first starting off this idea, we've got to think about what are critical factors, where are we going to get our proprietary research. Now we've done the research, and that's a big amount of the time, so I'm kind of compressing this. Now, once we've done that, we want to go and do our forecast, but we don't want just one forecast. We want to make sure that we've got an upside, a downside, and base case forecast. What I want to do here is, I'm going to shift a little bit here. This isn't upside downside base case, but what I want to try to show is that you want to be thinking about how you differ from consensus in a few different ways. I'm going to advance the slide and come back because I probably should put this other slide first. So let me go to the next framework I want to talk about, this advice framework. We did this massive survey when I was back at Morgan Stanley, and I've since done a lot of interviews with portfolio managers around the world. And they tell me that when analysts communicate a stock call, and it can be a 30-page report, it can be a 1 minute, 30-second or 30-second elevator pitch. This is what they want to know. They want to know, has the analyst made me, or this is what you got to be thinking about as students when you're doing the CFA Research Challenge, has that analyst gone on, made me aware of where they have greatest conviction and where they could be wrong? Are they differentiated from consensus? And this is really what I want to delve into in a minute, because this is where you can be thinking about what's my upside, my downside scenarios. You want to validate your work by doing some good research. Preferably, you're also getting it validated by talking to live sources of information. You want to always start with conclusions. This is a big problem I find when students are trying to learn how to be in the profession, is they're so used to writing term papers in liberal arts where they build to the conclusion on page 12. Portfolio managers don't have time for that. They're once going to get 500 emails a day. So what you do is you start off in the very first bullet what the conclusion is. I'm recommending a buy, I'm recommending a sell, and here's why. And you want to make it easy to consume. Now I'm going to go back to this prior slide. I hesitate to put the slide in here because it's very busy, but it has some really key things that I just want to try to touch on. So this is basically how to get from a price target up here of $50 a share all the way down to, let's say, a price target of 56. Now, that's scenario A. Every one of these is the same stock, and they're just, let's say, different analysts that are looking at the same stock. And what you'll notice was changes down here is you have different price targets. So same point in time, let's say it's early November 2022, stocks at 50. You got 4 analysts. One's saying $56 1-year price target. One's at 60, one's 66, and one's at $79. How do they differ? Well, you should be able to break this down. And this is important to be thinking about for yourself, because you want to be thinking about breaking down your financial forecast or your price target into 2 elements: a financial forecast and a multiple, valuation multiple. I don't care what methodology you're using, you want to be thinking about those elements. What is my forecast? You can be doing this with DCF. What is my cash flow forecast? And then what are all those different variables I'm going to be looking at, like my cost of capital and my terminal growth rate, that's ultimately going to have some impact. So we're going to call that valuation and your ability to forecast the company's prospects as your forecast. And what we have here is under item number 1. I'm just going to do, sorry, I keep on pausing because I want to just plug the, I got a new monitor here, and I plugged in, I plugged something in here and it kind of threw off my my tempo. Give me a second. I'm going to put in my slate, which I'm hoping is going to work here. Can you guys see a little cursor moving around? Here we go. Good. And so what we got here is up here is we've got the $50 share where the stock is now. The consensus basically right now is at $5. So if the stock's at 50 and they're expected to earn $5 a share, that's trading at a 10 multiple, right? 50 divided by 5. That's what this is just simply saying. What's the PE of the stock right now? If we assume the market multiple, let's just say this is the S&P 500, is right now, let's say 15 times, then if you take your stock at trading at only 10 times and the market's at 15 times, your stock's trading at a 33% discount to the market. For those of you who've done relative valuations, this is pretty straightforward. For those of you who haven't, I'd strongly encourage you to learn this because it's widely used by practitioners. It's not covered as much in academia. And so what we'll say here is this stock's trading at a 10 multiple, 33% discount. So all we've done here is we've just simply identified where is consensus for the next 12 months and where is the valuation for the stock. The next part, we're getting down to part 2 here, is now we want to say how much growth is there, because stocks are driven by growth, right? And so we say, well, the consensus for year 2, so because keep in mind, this is year 1, this is the next 12 months. So we like November of 2022 to October of 2023. This now becomes November of 23 to October of 24 in this example. And the analyst consensus is at $5.60 a share. That $5.60 compared to the $5 that's for the next 12 months is 12% growth. So basically the analyst consensus, kind of we'll call the herd or the mob out there, is just simply saying this company should grow at 12%. Everything I've talked about to this point in steps 1 and 2 here are just simply consensus. The key part, the reason why I'm talking about this slide, is that you as an analyst, you as a student group, want to have a differentiated view. And so what we're going to do down here in part 3 is how much do you differ from consensus? Well, this analyst here is very undifferentiated. They're going to get fired, at least if they keep doing this regularly. They're at $5.60, which is where consensus is. But you're going to see here in a minute, I'm going to get over to scenario B, And this analyst is actually a little bit higher. This analyst is 7% above consensus. And once again, remember, this is year 2 estimates. So year 1 estimate is $5. This analyst is we don't even know where this analyst is for year 1. Doesn't matter, because we're going to build price targets on year 2. So this analyst is saying the company's going to go from $5. You're going to get to the 560 consensus heads, which is 12% growth. But then this analyst is saying, I'm going to get another 7% growth here because I'm expecting $6. So the analyst is differentiated here by 7%. The next thing that we want to talk about over here in part 4 is valuation. Remember, it really comes down to price target is a forecast times the valuation multiple. Well, we got the forecast of $6 up here for this particular analyst. And if we say, well, let's start off by saying, what's the market multiple going to be a year from now? I don't know. I don't know if anyone ever can predict what the market multiple is going to be a year from now. So what I typically tell practitioners and students, use whatever it is now, which is right up here, or just assume reversion to the mean. And either case, 15 is been about the 15, 20-year average, and that's about where we are now. So let's assume that in a year, the market multiple's at 15 times. Then the question for the analyst, just like they're trying to figure out how they differ in terms of the financial forecast, is where do you differ on your valuation multiple? This analyst isn't differentiated. They're still saying the stock trades at this 33% discount. So if we say a 33% discount to a 15 market multiple means the stock itself will be trading at about 10 times forward earnings. So they're using an in consensus, kind of in line with consensus, 10 multiple times their $6 of earnings power gets you a $60 price target. How much do they really differ from consensus? Well, the first 12% up here is growth is just consensus. So this is really the only place where they're differentiated. So they do have a little bit of differentiation down here. This analyst over here, analyst A, once again, they need to be fired because they have no differentiation in terms of their earnings forecast, and they have no differentiation because they're still at a 33% discount. If we put this on steroids and go all the way over to analyst D, who's the most differentiated, this is just to kind of really illustrate the point, that you still have all the same numbers here on the top. Parts A and B, parts 1 and 2 are all up here. Everything kind of up in this section here is the same for everyone. But we get down here, this analyst is 18% higher than consensus for year 2. They're at 660, consensus is at 560, so you get an extra $1 of earnings power. And they're assuming that the stock trades not at a 33% discount, but only a 20% discount. Well, a 20% discount to a 15 multiple gets you a 12 multiple for the stock. If you put a 12 multiple, PE multiple, on $6 of earnings power here, you're going to get a $79 stock that is 58% upside. Does the analyst deserve all that credit? No. We got to say the stock would go up 12% just simply due to their earnings growth from year 1 to year 2. So they don't get all the credit, but everything but that 12%, they get credit being differentiated. Now let's hope they're right? If they're differentiated, they're wrong. That doesn't really do much good, right? And so the key thing I'm trying to say is, as students, and even once again, I preach this to practitioners, is know where 1 and 2 are, and know how much you differ in terms of 3 and 4. Really important. And then that kind of just plays into this idea of when we look at the advice framework, what portfolio managers want us to be thinking about in terms of doing our work, they want us to be differentiated. So the more differentiated, the better, as long as you're going to be accurate. Okay, so went through the idea of coming up with upside, downside, base case financial forecasts and kind of how they build. We want to talk a little bit about price targets. Now, price targets are going to be different than earnings, because we just talked a little bit about building an earnings. I actually did build the price targets, but was talking a little bit about the earnings, the $6 versus $5.60. Now we want to be thinking about actually getting to these differentiated price targets. Now, if you were a portfolio manager and you had the opportunity and you were super busy, because they always are, right? And you could only talk to one sell-side analyst out there on a given day about a stock, and you had 3 different analysts who wanted your time. The first one comes to you, and the stock you're looking at was at $8 2 years ago, was at $9 last year. Right now, the stock's at 10. And there's one analyst you could talk to, you're kind of familiar with. They say, my 1-year price target is $11. That's where I think the stock will be in a year. You could talk to them. That we'll call that analyst A. Analyst B comes along and says, I also think that the stock will be at $11 in a year, but I think it could be 12, or it might be flat. It might be dead money. They just stay at $10 during the year. You could talk to, we'll call it analyst B, or you could talk to analyst C here, comes in and tells you, yeah, it could be as high. I'm also at $11. Sorry, I forgot about that. So I'm also $11, but it could be 14, could be as low as 8. Who do you want to talk to? I'm in a room live, and everyone's always going to say it's analyst C, right? And this is the idea: is you want to be able to share your thought process with your audience. In this case, the judges. You want to make sure that they understand what's your upside and your downside scenarios. I'm just going to throw a graphic here because I just almost lost it in terms of how funny I thought this kind of was, because back when I was at Morgan Stanley, we built something like this to start with as a upside downside base case that ultimately became institutionalized at the firm, and then it's now been institutionalized. At least half the sell side firms out there now have this. And recently, when I was updating my phone app for my Morgan Stanley iPhone app, look at what they've got there. Their icon for like what we do in research is their upside. It's kind of hard to tell, but this is kind of historically what the stock's done. And this is supposed to be their upside, their downside, and their kind of base cases right there. So they're using this. This is so institutionalized. It's such a valuable part of what the clients want. They're saying, we're going to make this our icon. So really important stuff to try to come up with an upside downside base case. I'm going to shift the gears a little bit now. We're going to go into valuation. When I teach valuation, especially to students, but even to practitioners, sometimes they have this thought that valuation is like GPS. I'm going to find the exact address for that Starbucks I need to go to. And yet the more and more that I did valuation as a practitioner, and the people I really respect out there that write and talk about valuation extensively, I would say that we look at it more as you would almost like rating hotels or vacation spots or restaurants, and that is this a 4 or a 4.5 or a 5? It's not, this is the exact address I need to get to. So think about that, because sometimes I find students especially will spend 5, 10, 20, 30 hours in their valuation work thinking convinced they're going to come up with a better price target. That's not going to happen. You do need to spend time on valuation, but spending your time understanding the financial forecast, that's super important. Getting that right, understand what this company's prospects are, all that stuff we talked about earlier, getting proprietary sources to figure out what's likely to play out. But valuation is important, and I want to just talk about it for a second here. When I was writing my book and then ultimately building out some training material, I said there's so many different valuation methods people talk about. If you get somebody a real valuation like quote unquote expert in the room, they may pretend like there's 50 different methods, and there are a lot. But the reality is that you can distill them down to about 3 or 4 primary methods. What I've done here is I've added a few here. The blue ovals or kind of rectangles with the navy blue are the most popular valuation methods that are used out there that are multiples based. So basically taking something and multiplying by a multiple. The shortfall of multiples is that you typically are talking about one time period, like the next 12 months, or maybe the 12 months after that. The problem is that if you would have been looking at Amazon 10 years ago, they went through a number of years where they had no earnings growth. And then all of a sudden their earnings grew in like a 4-year period, grew 10 times. So if you were using those periods, you would have come up with kind of the wrong expectations. So the other way to do this is multi-period intrinsic value methods, which is going to be down here in tan, this DCF. And what I'm trying to show here is that if you're a little bit confused about all these different valuation methods, I'm trying to kind of bring some sense to that, is that down here in this kind of, we'll call this kind of quadrant here, this corner, as you work your way down here, this is a flow chart, you can start here. As you work your way down to this corner, you're going to get closer and closer to free cash flows. And even though there's a lot of kind of mystery that goes around and kind of subjectivity goes around evaluation, the bottom line is that we're trying to figure out what the company's free cash flow is going to be and how do we value those. And so what I have this flow chart to do, and I'm not going to go through it entirely, but it takes you through this and ask you questions so you can keep on trying to get down near the bottom. Because ideally, you're going to either use a DCF approach or price to free cash flow. Now, these are both can be problematic. There is no one valuation method that's perfect. These can be problematic. And so you will find a lot of practitioners will use PEG or PE because it can eliminate some of these problems that you'll see in a price to free cash flow and DCF. But these 4 methods I would contend are the best. So the reason I bring this up is that if you can use these methods in, for example, CFA Research Challenge, don't spend time up here. I find students sometimes want to start doing all this work up here. I'm like, but these are inferior because you really want free cash flow. And these are so far from free cash flow. I mean, you got a company like Uber hasn't generated earnings for, well, it's 13-year history. So people have to go value on these. Well, so that's why they have to use them. But if you can look at a high quality company like an Amazon and value down here, do that. This next table is just once again, kind of try to demystify a little bit of valuation. These are the types of things that will help us, that we're trying to ultimately try to use valuation to do. And I put relevance over here. This is subjective. I just said, I think 3 is being high. These are some other reasons why people will talk about valuation methods being useful or not. The reason why I put the weightings here is that I put the most popular valuation methods here, and I put these ratings basically, I think green is 3 and yellow is 2 and red is 1. And what I do down here is if you sum all these up, the bottom line is if you sum all these different things you would use and you weight them, you'll find that the valuation methods that are the best are PEG, price to free cash flow, and DCF. And PE is not bad, and dividend yield is not bad. And then this EV to EBITDA and price to sales and price to book, they're really not good valuation methods. And the two things I want to touch on just quickly on DCF, I think academia tends to put an outsized amount of weight on DCF, and we can talk all day long about it, but I think someone might have their mic live. They may want to mute that. So DCF, I think it has its place, and there can be some benefits to it, but I just want to let you know that there's studies out there, and I can just tell you as a practitioner and as someone who managed about 500 analysts globally, that a lot of analysts will use DCF to reverse engineer to get to their price target. So portfolio managers, especially in the United States, are very skeptical of DCF. Not saying don't use it, but you don't want to be the only method that you're using. This is one of my favorite academic studies ever. They went out and looked at 120 DCF models between 2013 and 14. I don't know if they grabbed them randomly or they were the most detailed ones, but they went through them and they found on average of these 120 DCF models, there were 3 theory-related mistakes and 4 economic judgment mistakes in each one. There were 7 mistakes in your average DCF. And being someone who looks at lots of DCF models, there are more in student models than practitioners, but I tell you, I find them in practitioners models as well. So be very, very, very careful about doing DCF because you can make a lot of places you can make mistakes. So when you think about valuation, once again, going back to this idea of just simply, real simple, it's a forward-looking financial forecast. I hope you spent time researching, and you're going to put some kind of multiple on it. You can, once again, you can do this with a DCF. Think about, in effect, the variables you're changing. That's going to be your implied multiples. And you ask yourself, how much time should we be spending on these? Now, this is a pie chart. The idea is just to start with like 50-50. I don't know if students, I would say, do 50-50, but I would say I do find periodically students are kind of stuck in this mindset of spending almost as much time on building out the valuation for their model as they are. I'm trying to get this to animate here. Here we go. They're spending almost as much time on doing the valuation work as they are over here actually creating a forecast. But the forecast drives your valuation. The faster growing companies deserve higher valuation multiples, right? And so this is probably more indicative of what we should really have. Namely, spend the vast majority of your time doing the research on the company and then do the valuation work. What you don't want to do, and I've seen this in practitioners, is they come up with a stock, they have a great idea, and they're like, the stock's at 70 right now. I think it probably will go to 100, and let's back into evaluate. Let's use a DCF to reverse engineer into how I get to a $100 price target. So make sure you try to avoid doing that. This next one is talking about kind of what we should be thinking about doing as, again, could be students, could be analysts, when we're building our price target. And I remember there was 3 elements I talked about, actually 2 elements I talked about a minute ago. I said it's just simply the forecast times the multiple. What I've done here is got a little more sophisticated, but I'm sure all of you can track here, is this idea that we're going to break down the multiple I talk about into 2 blue boxes. So there's one blue box that's going to be kind of a lighter and a darker blue. We're going to say, what is the market's multiple? Let's say, in this case, I'm just using 14 as an example, times whether you think the stock deserves a premium or a discount or should be trading at the market's multiple. So we're just adding one little minor dimension here. And because you can do more company-specific things here in the navy blue than trying to just come up with just a stock multiple. So you're kind of taking out the market risk here by coming up with a market multiple, because most practitioners, and I would say students as well, either use reversion to the mean or an average over the last, or what it is right now. Don't try to second guess where you think the market multiple will be a year from now. But the idea that our jobs here are to say, if we think do some work and say historically, based on the run rate of this company, we think that $1 of earnings power is about kind of it can be just simply the consensus thinking out there. And don't give it too much thought, but just say that based on a run rate, this is about where the earnings power should be for the company. Let's say the average PE multiple of the market for the last 10 years has been 14, or under the current economic conditions, it's typically 14. And the stock historically is traded about a market multiple. So if we do the math here, we say, well, $1 of earnings power times 14 times no change to the company doesn't get a premium or discount, you wind up with a $14 stock price. Then the next step, and this is the part that the great practitioners do, and I see really good students know how to do, is you want to go from an outside view. Outside view is just using kind of historical run rates, and then you're going to move into your own inside view, and you're going to add your expertise. Our job is to figure out what is wrong with consensus. Let's just say this is the consensus run rate. The company's not going to earn $1, they're going to earn $1.10, and here's why. Because I found this critical factor. I went and found some unique source of information. I now have my information asymmetry, and I'm going to come up with a better idea than anybody else. And the second element you're going to be able to do is, once again, I wouldn't try to second guess where the market multiple is going to be a year, but you can say, because they're going to grow faster, I think they deserve a better premium to the market, or a premium to the market. And so if I put a 10% premium, 10% of 14 is 1.4, right? So I can ultimately say a 15.4 multiple times $1.10 of earnings power gets me my $17 price target. So what I'm trying to really drive home here is where you can work your magic, and you and your team can do really well, is come up with a better forecasting consensus and come up with a better valuation multiple, or in this case, a premium or discount to the overall market multiple than the consensus thinking, the current thinking. Now I'm going to shift gears here a little bit into this idea. So we were talking about here valuation. Now we're going to get into talking about some of the things that analysts do or don't do to be better stock pickers. This is really the tier framework is really about stock picking. And I want to pause for a second here. This is a slide I typically use more with students than I do practitioners, but sometimes with practitioners, in that you typically will have students in kind of one end or the other here in this scale. They'll either do super deep dive and know everything about the company, and they can tell you, how many employees they have and where their plants are and the cost to produce something, which can be really helpful and really, really important. And that in itself makes you what I call an industry consultant. You have other students at times that are just day traders. They'll know everything on CNBC. They know why a stock went up yesterday. They'll tell you why they think a stock is going to go down today, and they have a pretty good understanding of the market psychology. But I'm going to call them a day trader. A really good equity research analyst and a really good student who's going to just crush it with the CFA Research Challenge has a blend of both. They understand the fundamentals of the company, but they also understand the psychology of the stock. See, I got a few more slides here. So this tier framework I talked about, here are the 4 steps. When I was writing my book, I went out and interviewed about 100 people to give me their thoughts. And once again, I had been an analyst for 14 years. I'd managed analysts globally for about 2 years. So I had a pretty good idea, but I wanted to make sure that I had everybody's thoughts out there. So I also went and interviewed a lot of buy-side people. And I took these 100 interviews, and I had dozens of pages of notes on. One of the questions was, what is your method for picking stocks? And I was able to distill them down into these 4 buckets. That good, disciplined analysts who really have a methodology here, they come up with price targets. They know what the catalyst is that's most likely going to drive their stock. So it's the iPhone 15, and it's because of X, Y, and Z. And I think the stock's going to start to move in May because people start talking about all these new things that's going to be, the next iPhone is going to cure cancer, and it's going to come out, and people are going to be talking about May and June, and the stock's going to take off. They think about timing. They're not in too early, they're not in too late. That's this idea of thinking about entry point, and they're always reviewing their performance and thesis. Now, there's a lot more to this. I'm not going to go through it in detail, but this is all part of this kind of broader framework. So if you are interested, you can go through these. A lot of these, at least half of these, fall into the field of behavioral finance. So if you have a behavioral finance class you can take, or a professor that's willing to teach you those things, that can be really helpful, because some of these things here really fall into the idea of behavioral finance. And so moving on, so those are things you want to be thinking about as students. Come up with a good price target, figure out what the catalyst is that's going to move the stock. You really don't have much latitude in terms of timing. I mean, you can't wait until after the competition is over to make your stock recommendation. So you do have to kind of think about, like, what do we want to buy or sell at this point in time? And typically analysts are always reviewing their performance. Don't know you really need to do that once your pitch is going, but obviously if something comes up during the competition, you want to be thinking about incorporating that into your thought process. And then the last part, and I briefly touched on this earlier about in terms of the advice framework, is to make sure that you're focusing on the things that portfolio managers want to hear. And just a little bit beyond the scope of this, but the idea here, that early on when I was telling you to make sure you do good, solid research, this is what portfolio managers want to know that you've done. You've been doing this type of work. It's forward-looking, it's novel, it's thorough. If you gave it to them, they'd come up with similar conclusions, revealing. What I really want to touch on here, though, is step 3, is the advice framework I talked about. Portfolio managers want to know, and your judges are going to want to know, are you aware of where you have conviction and where you're differentiated? Are you aware of where you could be wrong? So scenario analysis is really big in helping in that area. Portfolio managers want to know, how do you differ? Don't tell me something I can go read in the Wall Street Journal or Refinitiv or Bloomberg. Tell me something that's differentiated. Have you done your homework? don't just phone it in the week before, kind of jam it all together and have your report done, but really do some work. And ideally, you go out and validate with third-party sources. Make sure you start with conclusion. Once again, don't write a term paper where you get to the conclusion at the very end. Always start with even the paragraph. Start off with what your key point is, because portfolio managers don't have time to be reading 10-page reports. I know we have 10-page reports here, and that's fine. You do want to be very thorough with the judges here. Don't get me wrong. I'm not saying don't be thorough, but that was over here. But start with conclusions. Make it easy for them to consume by starting with conclusions. And speaking of conclusions, I think it's going to bring us full circle here. So as analysts, as students who are presumably interested in getting into this field here, you want to make sure you're coming up with really good insights. Do the research. Once you have the research, and don't go too early into this, make sure you're thinking through your forecast. If you got a good forecast that's out of consensus, you can make a stock recommendation. Then you got to get out there and actually motivate other people to take your idea. I threw this in here just as kind of a little extra for anybody who's thinking about getting into the field. This is something I use either with students and also when I go to sell side or buy side firms and they just brought in a new class and they say, how do we get promoted? These are the 10 things that typically challenge new analysts when they're getting into the business. And I think that's it. And so if there are any questions, I've got a few minutes, I can take them. And so, yeah, thank you very much.
Wow, that's a lot. Thank you, Jim. This is awesome. I just have a couple questions as I think about, the way that points are allotted for our competition.
Yeah.
You mentioned know where the risks are, know where you're wrong, to be aware of both the bull case and the bear case scenarios. What's the best way to build that into your forecast and your price target process?
Yeah, so there's a few things. First, the good news is, unlike some of us here that were doing this, let's say 25 years ago, companies since then are more and more required to put actual risk sections in their MD&A. So I would go to the MD&A section, just figure out at a minimum what the company I'm looking at and all of its competitors, like its top 4 or 5 competitors, are saying in the risk section, because those are really important. The next thing is I'll go to the sell side reports where they do an upside downside base case, bull bear base case, and almost every one of those will talk about in their bear case what the downside is, right?
Yeah.
And third is, if you have the ability to go into Refinitiv and look at the analysts that have the lowest estimates on your company out there, especially for next year and the year after, going not necessarily for the current quarter, but further longer term out, go and look at their reports, because if they're the low on the street, they probably don't have buys on it, and they probably have to have a reason why they don't like the company, and they're probably talking about some risk. Now, they may be completely wrong and just out left field, but it's at least something to make sure that you learn, what you potentially don't know.
Right. How do you think about analyzing a stock in the period that we live in right now with all of these macro headwinds? And they're all not related specifically to the company, but there's interest rates, there's inflation. How does that macro stuff reflect itself in your analysis when you're just looking at a single stock?
Yeah. So one of the things that I follow Peter Lynch on this. Peter Lynch once said, if all the economists in the world were laid head to toe, it would be a good thing. And so I just don't know that I can second guess where the Fed's going to be and where the economy is going to be. I think probably more than any time in my, I guess now probably 30 years of doing this, I think we're like, everyone just knows there's going to be a recession. So I think this is a very unusual time where you should be, if you're not assuming there's a recession, then you're definitely out of the consensus. And very often recessions kind of creep up on us, right? We don't really even know we're in one until we are. And so what I'm advocating to those who come to me at this point right now, and they're like, look, I'm looking at an industrial stock and it's beaten up. Should I avoid it because we may be going into a recession? And I said, well, it depends on the valuation. And what I tell individuals to do is go back and look at two things. We go back to this idea of forecast and valuation multiple, right? Go back and look at the forecast, the last 2 or 3 recessions, and ask yourself, how bad did things get for your company? Maybe it's horrendous and it took 3 years to get back to the pre-recession earnings level. Maybe it didn't. Maybe they got a lot of business under contract, or maybe a lot of their business is actually kind of sticky and people don't necessarily go away from it when the economy slows. And so figure out what that dip in earnings power is likely to be, and then go look at what the valuation multiple did in the last few recessions. And if you say, look, the dip already is factored into the stock in terms of analysts already been lowering their numbers, or the valuation multiple is so much lower than it's ever been before that the analysts are already baking in the expectation the estimates have to come down another, let's say 10%. If you do all that math and you're like, there's only about another 10% downside, but there's 50 or 80% upside, then that's where you start to say, look, I'm acknowledging that maybe the stock is dead money or even down here over the next 6 months, but there is such a huge return at the other end of this. The trick or the key thing, the part of this is to make sure you actually go and do the historical research. Because
Yes.
I know recently, having done this with a few students, it really kind of eyes popped out, because there were some where they were like, wow, it took like 4 years for the company to get back to pre-recession earnings power after the 2008 recession. And I'm like, that's right. So you can't just dive into something and say, hey, we're going to come out of this in 6 months and make a lot of money.
Good. Yes, that was a great answer. Final question for me. You mentioned earlier about the relative aspect of this, using the market multiple and then deciding, is the company worth a premium or a discount to that market multiple? What are the factors that play into that decision? And does ESG factor into that at all? Is a company that's really good in ESG, does that necessarily trade at a premium to the market? How do you determine that?
Yeah, so to me, it all comes down to corporate earnings growth. That companies that are expected to have stronger corporate earnings growth are going to trade at higher multiples, and those with weaker will be at lower earnings multiples, more relative multiples. ESG, I'm kind of on the one hand, I do think ESG has a place. I think it makes companies focus more on doing the right thing, and I do think that we want to see companies doing the right thing. I don't know that I've ever seen an analyst come out and say, I made a really good stock call, it made us X dollars, or it outperformed the S&P by 100 basis points because we went in with the ESG factor. So I view it more as it's something you should know, and it should inform you on how you think about the company and its ability to execute. But I don't know I would use it as one of my critical factors.
Gotcha. Well, this has been great. I want to be conscious of your time. We thank you so much for taking an hour out of your day and sharing this with us. It's such a comprehensive view of what it's like to be an equity research analyst. I'm sure this is going to be super helpful to all of our teams.
Well, thank you for having me. I really appreciate it. It was a lot of fun.
Thank you, Jim. Yeah, thank you. We're going to have, these slides will be on the website, everybody, so you can take another look in more detail. Everyone have a great weekend. Keep working hard, and we'll be talking to you again soon.
Take care.
Thank
Bye-bye.
you, Jim. Thank you very much.
Thank you, Chris. Thank you, Chris.